I'm holding Peter Lynch's book, Beating the Street from 1992, and dude, Peter Lynch is a legend because he averaged 29% returns for 13 years straight, managing Fidelity's Magellan Fund. And in this book, he was so excited about a company called Allied Capital II that he recommended it to millions of readers. But there's a problem. That company turned out to be one of the most notorious accounting blowups in the BDC world, and about $1.6 billion in shareholder value was wiped out. And just the other day, I bought more shares of it. Now, I didn't buy the fraud. I bought the company that cleaned up the fraud and turned it into a dividend machine. So, hey, let me explain. But first, what's up? I am Russ. I am a blue-collar welder. This is not financial advice, even though it may sound like it. These are just my thoughts shared for your fun and entertainment and informational purposes only. So, as I was saying, just the other day, I added 4 more shares at $19.49. And I now have 575 shares with an average cost basis of $19.29. And I'm collecting about $1,104 in annual dividend income. And I plan to keep buying more. But to understand why I keep doing this, we need to go back to 1992 and explain why Peter Lynch was so excited about it, but why he ended up being so wrong as well. Allied Capital was what's called a business development company, or BDC. These companies make high-interest loans to middle-market businesses, which are companies that are too small for the big banks, but too big for something like your local credit union. And the BDCs charge these middle-market businesses 10 to 15% interest, then pay most of that income out to shareholders as dividends. Peter Lynch probably looked at this and thought, this is perfect. High yields and steady income, what could go wrong? Quite a lot, it turned out. So we fast forward to 2002, and a hedge fund manager named David Einhorn stands up at an investment conference and drops a bomb, saying Allied Capital is cooking the books. They're marking loans as full value when they're basically worthless. He even found cases where Allied said a loan was worth 100 cents on the dollar, while the senior lenders, the ones who get paid first in a bankruptcy, were marking the same company's loans at 0. Now, Allied fought back hard. They even illegally obtained Einhorn's phone records, trying to dig up dirt on him. But the truth eventually came out. In 2007, the Securities and Exchange Commission found Allied broke securities laws. In 2008, a key executive at an Allied portfolio company was sentenced to 10 years for what prosecutors called the largest fraud in SBA history. Also in 2008, a portfolio company bankruptcy causes their stock to crash, and then in 2010, the stock was sold for $3.47 per share, which was down 90% from its peak. Peter Lynch's pick was destroyed and investors lost almost everything. But I found this fascinating that on April 1st, 2010, another BDC called Ares Capital, ticker ARCC, they ended up buying the remains of Allied Capital. Now you might be thinking, hey Russ, you just said that Allied was a fraud, so why in the heck did you buy the company that bought the fraud? So check it out, and I want to be clear here, is that Ares Capital and Allied Capital are two completely different companies. Ares Capital has been around since 2004 and has paid dividends continuously since its IPO. They are now the largest BDC in the world with a market cap of around $25 to $27 billion, depending on the quarter, and a portfolio spread across about 550 companies. About 64% of their loans are first lien senior secured, which means if something goes wrong, they're the first in line to get paid. And many analysts consider them the BDC gold standard. So essentially, when Ares bought Allied in 2010, they acquired the assets, they cleaned up the mess, and they turned it into something legitimate. The irony is that Peter Lynch was right about the concept BDCs can become great income investments. He just picked the wrong company. The bottom line was Allied Capital was the fraud, but Ares Capital, which I own, is legitimate. So here's a little bit of my strategy with Ares Capital and why I keep buying more. First, I try to buy when the stock is trading below its net asset value, or NAV. Think of the NAV as like the book value of the company. It's what the assets are actually worth, and according to their most recent quarterly report, Ares's net asset value is $20.01 per share, and just the other day I bought at $19 $19.49, which means I'm getting $1 worth of assets for only 97 cents. I got impatient and bought shares in the $21 to $22 range because I wanted to keep feeding my income factory. So I'm far from perfect at this strategy, and I'm trying to be more disciplined and buy Aries when it is trading below its net asset value. And here's why it matters, because there's two sides to this. For us as buyers, when we buy below the net asset value, it's like getting a discount and buying $1 for 97 cents, which is just smart shopping. But for the company that's issuing shares, and this is the part that's important to understand, BDCs constantly issue new shares to raise capital so they can make more loans and grow. And if Aries issues new shares when the stock is trading at $21, which is above the $20 net asset value, they're selling $20 worth of assets for $21. That's accretive, meaning it adds value for existing shareholders. It's like the company is getting a premium. But if Aries issues shares when the stock is trading at $19, below the $20 net asset value, they're selling $20 worth of assets for only $19, which is dilutive, meaning it destroys value for existing shareholders. So as a shareholder, I want the company to issue shares above NAV, and I want to buy shares below NAV, which really is the best of both worlds when I can get that discount. So below net asset value helps me, above NAV helps the company, and that combination can help our income compound faster. Now, unlike a lot of other dividend investors, I don't have automatic DRIP or dividend reinvestment plan turned on. I like to collect the dividends and then hopefully strategically reinvest them. So here's what I do. Every quarter, when Aries pays me dividends, which is currently 48 cents per share, that cash goes into my account. Then I try to be patient for the stock to dip below the net asset value or for another opportunity that's in my portfolio. And remember this, the advantage of automatic DRIP is that it forces you to buy fewer shares when prices are high and more shares when prices are low. But I prefer the control of doing it manually, even though it means I have to watch for opportunities. The bottom line is that I manually reinvest my dividends instead of letting it be done automatically. So Aries Capital is just one piece of my income factory, making up about 2.2% of my total portfolio. And another BDC I also have in my IRA is Main Street Capital, ticker MAIN, which is another 1.7% of the portfolio. And these are relatively small positions that I'm testing out over at least a decade to see how they perform. I love the book The Income Factory by Steven Bavaria, and he talks about building an income stream with higher yielding products like Aries Capital or Main Street Capital, and then reinvesting those dividends for the growth. So overall, Aries Capital is just a 2.2% position in my investment portfolio that I'm kind of testing out this income factory idea for several years. And if you follow the channel, we'll see how it goes. But don't forget, every investment has its risks, especially BDCs. The biggest concern people have right now is falling interest rates, and Aries makes most of its money from floating rate loans, meaning when the Fed raises rates, Aries' income goes up, but when rates fall, their income goes down, and currently, analysts expect their earnings to drop about 7% in 2025 and another 2% in 2026 as the Fed cuts rates. But here's what gives me confidence, and check this out. First, Aries navigated 2009 to 2016 when rates were near zero. During that entire period, they stayed profitable and kept paying dividends. They also acquired Allied Capital in 2010 during that zero rate environment and grew into the largest BDC in the world. So we know they can operate successfully in low rate environments. And second, when interest rates fall, it actually makes higher yielding stocks like Aries more attractive to investors. I mean, think about it. If you're getting 0.5% in a savings account and 4% on a treasury bond, suddenly a 9 to 10% yielding stock looks pretty damn good. And that demand can help stabilize or even increase the share price, even as the dividend income could be declining slightly. It's not a perfect trade-off, but it's something. So falling rates, yeah, they are a concern, but Aries survived 7 years of ZIRP, the zero interest rate period, and high yields attract yield-hungry investors when rates are low. The second major risk risk is that BDCs can and do cut dividends. Not saying Ares will, but it's possible. Even if they cut the dividend 20%, we'd still be getting a 7 to 8% yield, which beats most alternatives. And when the dividends get cut, the stock price usually drops too, which means we can buy more shares at an even better discount and lock in whatever the new higher yield is at that lower price. But the key is being confident the company will survive and recover. I'm not worried about Ares going bankrupt because they've got about 550 companies in their portfolio, about 64% in first lien secured loans, and they've been doing this for over 20 years. So don't forget, dividend cuts are always possible with BDCs, but even a cut with many of them still leaves a good yield, and I'm confident Ares will survive. Hey, another thing you'll hear though is people talk about spillover income. Like Ares has $1.50 per share in spillover. People think it's a piggy bank sitting there to cover the dividend. Well, it's not. It's just accounting. The IRS lets BDCs keep some earnings on their books for tax purposes, but it's not actual cash sitting in a vault. So don't count on spillover to save a dividend. Instead, you should be looking at net investment income, or NII, instead. So remember that spillover is just accounting. It's not a real safety fund. Like Warren Buffett said, there are many ways to get to financial heaven, and buying income factory stocks like high-yielding BDCs is just one of those ways. But for me, we're keeping them small parts of our total investment portfolio. Again, 2.2% for Ares, 1.7% currently for Main Street Capital. So even if I'm wrong and they went away, it wouldn't be catastrophic. And like Peter Lynch says, you have to know what you own and why you own it. And I own Ares Capital and Main Street Capital for the income that they are producing that I can reinvest into other things. And they pay those high dividends because they're required to by law. And if you do want to see what this welder is buying and investing on, click the link below. Follow me on Blossom if you would like to, or sign up for the free and fantabulous weekly newsletter where I share all these stock portfolio moves and some stocks about to go ex-dividend and some interesting investing thoughts that I'm having with you every week for free. And just like Peter Lynch recommended Allied Capital, and he was wrong, sometimes we're wrong, but we learn from our mistakes and move on. But before you move on, you should click the video in this floating little box next to my head and watch that awesome video right there. And if you do, I thank you, and I will see you in the next one.